So Palantir Technologies is down by close to 20% from the highs in August, and investors are now wondering whether it makes sense to take profits or even short the stock. In this video, I'll provide you my thoughts and some of the arguments in my bull case. Have a look at one of the articles that was released on Bloomberg. This was on August 20th. It's crazy. I get to see a lot of articles in this. They have this flavor, value investors almost celebrating the fact that Palantir is down. And you can see, you notice who this type of article is targeted to. So these are short sellers. And when you ask most of the short sellers, why are you shorting Palantir? They're going to go to this argument, valuation. And of course, if you look at earnings for 2026, the street is projecting, I believe, 85 cents per share. I think I have here charts. There you go. So fiscal 2026, 85 cents per share. And the share price is 156 today, which means that investors are paying 90 times next year's sales for the share, which is a lot. How much is a lot? Well, that's 26 times the sector median. And when you look at other valuation ratios like the price to cash flow, 222. So Palantir is an expensive stock, but it's expensive for a reason. And the reason is because it's one of the best pure play stocks on AI. And shorting an AI stock like Palantir during an AI supercycle, whilst you have the macroeconomic landscape solid with rate cuts ahead, and a policy by the new administration that favors deregulation, which stimulates merger and acquisitions, there is no case for short sellers, at least not right now. So these are some of my points, but let's focus on what's going on in regards to the short float. So right now we have 2.5%, so it's not a large amount, and therefore the increase in share price is not because of short squeezes and shorts covering their positions. The increase is simply because funds are just loading shares left and right, and that's why the shares go up. So the short float is significantly lower than it was back in 2023. We can see there it was close to 10%. And then, of course, if it's 10%, you have short squeeze potential. But right now, you don't. Now, of course, because it has a lot of high volatility, Palantir, if you look at the S&P 500, is the stock that has the best return year to date, 107%, followed by Newmont and Seagate Technology. However, in the past month, particularly in the past 10 days, it's down in the double digits. So, it's one of the downsides that comes with this type of stocks that just moves aggressively. And when you look at the reasons why it's sold off, some people may think, okay, it's got to do with the company, or maybe there is a press release, or maybe it's got to do with the industry, or maybe what is the cockroach in the kitchen? Yeah, I just don't see it. So in the past month, I've seen this press release, aside from the earnings, of course. August 19th, we have a press release saying that Palantir is partnering with Fujitsu, and I don't know how you pronounce it. Probably you pronounce it differently. So Fujitsu is going to provide the Palantir AIP to the customers in Japan. Why is this interesting? Well, Fujitsu has a total headcount over 110,000 employees. That's a lot. And considering that the AIP platform can be used for agentic AI and can be used to reduce the headcount, not only for them, but for Fujitsu's customers, I think there is a big upside in Japan. So that cannot be the reason why shares are down by close to 20%, in mid-August. Now, when you look at the highlights in the earnings release, in the Q2 earnings release, the results are quite crazy. I don't know how to put a formal professional analyst term to what you're seeing on the screen. US revenue up by 68% year over year, 17% sequentially. And the reason why the company is pushing the quarter over quarter metric, the QOQ, is simply because, yes, there is seasonality because some companies may backweight their contracts for the end of the year when they have to, deploy the remaining budget. They have to burn it pretty much. But there is no seasonality in Palantir's earnings, so at least I just don't see it. Even though I believe management mentioned in Q3 or Q4 last year that there was some seasonality, I don't know. I just don't buy it. So U.S. government revenue up 53% year over year, and there was a massive 10 billion 10-year contract with the DoD. We have another U.S. commercial. This is one of the most important segments. U.S. commercial revenue up by 93% year over year, and sequentially up by 20%. That's a lot. And if this doesn't tell you that companies are adopting AI, I don't know what it does. Overall revenue, you're looking at all the different segments and you consolidate commercial and government, up 48%. So if you look at the rule of 40, if you add up the 48% year over year revenue increase to the adjusted operating margin, you will have a rule of 40, which is 94. So if you look at the chart, and here Palantir is comparing enterprise software companies that have over 1 billion in the last 12 months in revenue. That's 94%, in the rule of 40. And the difference is staggering. Of course, when you look at the variation of the rule of 40, it's crazy how this is going up. And the guidance for this year is 91%. So the ridiculous growth, and you can see it when you compare it to NVIDIA, for example, the rule of 40, which is right here. Here, you're comparing the rule of 40 with the top 25 market cap companies globally. And only NVIDIA is surpassing Palantir. So this gives you an idea of where the company is and what story investors are paying for. The story is revenue growth and operating margins. There you go. That's the reason. Now, if you look at what the US commercial segment is doing, this is one of the most important segments in Palantir. The revenue growth is 93% year over year, 20% sequentially, as I said earlier. The number of deals closed over 5 million or greater increased by 5 times. So 500% year over year. That's a lot. And that's telling you that companies are adopting AI at scale. So these are not small and medium enterprise. These are the big boys. The big boys are closing contracts. And this is one of the reasons why entry-level jobs are potentially disappearing. So it's quite raw for the new generation trying to find a new job right now. Now, when you look at the revenue in the US and the revenue outside of the US, the difference is staggering. You can see the US revenue to 2.42 billion in the past 12 months and just 1 billion outside. And most of that 1 billion is from the government, so non-US government contracts. Now, this is also telling you that the potential outside of the US is huge because many corporations are hesitant to adopt AI. So there is plenty of potential ahead. And when you look at the revenues, at the EPS and the revenue expectation that the street is projecting, well, we have an increase this year, 57%. However, you can see it in 26 and in 27 and so on. That is going down. So it's going down because of scaling laws. So you have 57% now because last year it was relatively easy to almost not double, but increase it by 57%. And next year, things are getting a little bit more raw in terms of gaining that increase in the bottom line. The same when it comes to revenue. So you can see revenue this year is projected to grow at 45%. In 26 and in 27, it's about 35% year over year. So revenue growth is slowing down, but it's because of the law of large numbers. The higher the number, the more difficult it is to grow. And it makes sense. Market cap for Palantir is 340 billion, I believe. So growing at this rate, 35%, it's, not seen in your day-to-day. Now, when you look at profitability, this is one of the things that investors are paying for. So gross profit margin, 80%, which is 61% above the sector median. So the IT sector median, the tech sector median is just 50%. When you look at net income margin, well, 4x. 4x. So the company is pulling in 4x more margins than the sector median. That tells you why the company is different. And when you look at the income per employee, I don't think it's a lot. I mean, Uploving, I think it was in the millions, I believe 1 or 2 million per employee. So it's not a lot. 183,000 is probably how much they pay for on average to their employees. However, if you look at the sector median, the net income per employee is just $8,200. So Palantir is 21 times above the sector median. Looking at interest rates, this is one of the things that can affect the stock, particularly due to its high beta. So we have 90% chance for a rate cut in September. And if you look at the December consensus, 50% chance for a cut by the end of the year, and then 38% chance for 2 rate cuts. So overall, we're talking about 88%, about 86, 85% chance for 2 rate cuts before the end of the year. So this is highly favorable because the more rate cuts you have, the more liquidity you have in the market, which means the more funds and retail investors are willing to take risks with bets like this one. So overall, I'm bullish on the stock, and I just don't see any strong arguments as to why their story, their narrative is going to deteriorate in a 3 to 6 months period. Even though the price right now looks a little bit, I don't think, by the way, it looks bad, because I see a consolidation happening. So what you see here is relatively similar to what you saw at the beginning of the year. The price consolidating. Of course, at the beginning of the year, you had a tariff tantrum. So that was one of the reasons why it was consolidating in this price range. But you see, even if you go back in time, you can see periods where the price is consolidating before it runs. So yeah, I don't see this as something negative, even though I don't expect, a triple-digit return in the next 6 months. Let's be realistic. Probably it's going to stay here for maybe end of the year, and then it's going to take off in 26. So that's my view on Palantir. Let me know your thoughts in the comment section, and I'll see you in the next one.